most common deal structure is going to be your non-owner occupied business purpose loan, secured by residential real estate to an entity borrower. If you meet those fact pattern, which is the most common fact pattern, if you meet those fact patterns, licensing requirements for lending is actually pretty nice. Only about 10 states require a license to do that kind of lending. And it's mostly on the West Coast. So let's go from the East Coast to the West Coast, right? So on the East Coast, it's just...
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. We do appreciate it. We have a guest today. We have a cool guest. It's going to be a fun talk today. We have Kevin Kim from Geraci Law Firm, an attorney and also the host of the Lender Lounge podcast, one of the few industry podcasts. Us, Kevin's, any others? I don't know. Not all that many. But yeah, thanks for being here. We appreciate it. Thanks for taking the time.
Of course. Thank you for having me on, guys. Appreciate it.
Yeah, sure thing. If just getting started here, if you wouldn't mind, could you give the audience just a little background on yourself, your practice, how you ended up in this niche?
Well, my name is Kevin Kim, partner here at Geraci LP, or Geraci Law Firm. We are the nation's largest law firm that's really explicitly focused in private lending. I joined the firm in 2014 as a contract attorney. I had my own law firm, and it was, if you guys remember back 2014, the market was just ready to grow and the firm grew with it. And today I'm one of the partners and manage the firm's corporate and securities division. I specialize in debt fund formation for private lenders, also any other kind of capital raising vehicle in the securities realm, raising money. But also we do a lot of corporate work. We do governance, transactions, M&A. And then finally, we also do a lot of licensing work for private lenders across the country. And then the firm's other departments, our largest division is our loan doc, closing doc, service, our banking and finance division, alongside our lightning docs company, is a sister company of the law firm. Both are in the business of producing loan documents and other documents for private lenders on their day-to-day transactions, right? And then we have a litigation, bankruptcy, and foreclosure division that's really focused in California, primarily because it's litigation. But our national practice is definitely national. And overall, the firm has been doubled, triple, quadrupled down in, private lending, hard money lending, private money lending, whatever you want to call it. And we really love the industry and we really believe in its value. So,
well, you definitely hopped in at the right time because 2014 was probably right when institutions started coming into this space and started deploying billions of capital. I remember when Chris and I started Hard Money Bankers in 2007. We're like, this industry is too small for banks and institutions and Wall Street. They don't want to be in this space. There's not enough deals out there. There's not enough money to be made. And we were wrong. But,
the firm was founded by Anthony Geraci in 2007, right in the middle of the recession.
Yeah.
And that was it. That was the reason why. But man, come 14, it just became.
Woo. That's right. Yeah. And a lot of our followers and listeners and viewers on our podcast are call it what like you said, private money lenders, private lenders, hard money lenders. Most of them do not take on institutional capital. Most of them lend their own money out, or they either have a fund or they raise private capital from friends and family. What are some of the common ways that you see private lenders deploying capital? Are they pulling money from individual investors? Or are they creating debt funds? Are they creating equity funds? Like, what are some of the common ones that you see out there?
That's what I love about this space. It's so fragmented and so diverse, and that's a good thing, I think. Right? There's no right or wrong way to run a private lending business. Right? I've seen all types of iterations, and we represent lenders of all shapes and sizes. We have there's a strange like message going around in the industry that like we only work with the large shops, and people are like, no, I represent solo mom and pop lenders, like literally individual investors that fund their own loans with their own balance sheet, all the way up to, the national shops, right? And even the guys who are buying loans above them. So, and there's a broad way. There's no right way to do it. Most common is, well, at least right now, the most common right now is typically to utilize, they kind of have three big buckets of capital, right? One, they have their kind of the high net worth investor driven capital, whether that be done through, co-lending or a debt fund or a note offering. They have that resource. And then they also have their capital markets relationships, right? They usually either, table fund, correspond, or sell to the secondary. And then the third bucket is kind of everything else, right? And that's usually more of a brokerage relationship outwards, right? And that also involves your DSCR product, right? So most of my clients who have somewhat stabilized their business, has somewhat kind of made it a real going concern, are doing that. But it doesn't mean that that's the only way. I have lenders. There's a client of ours out in the Ohio, Kentucky market. They're running on just bank lines, right? They have a small balance sheet of their partner's money, multiple lines of credit from banks, regional and local banks, and they're killing it, right? And they hold everything. They don't sell it. They just keep it. Other clients utilize what is it? These short-term revolvers and sell to the secondary. Other clients purely high net worth investor driven, not even a fund, just we call it trusted investing here in California, or co-lender, I think it's called on the East Coast. Yep. And they just do it that way. And there's nothing wrong with any of those issues. They all have their limitations. And so like one of the best pieces of advice that I got in the space for the kind of tell new lenders is I interviewed Beth O'Brien again recently, because of her new business, and she was, shout out to Beth. I
heard that one.
You want to have different buckets of capital, whether you're a big national shop or an institution, or you're the local lender. You need to have buckets of capital because there's no such thing as one size fits all, right?
Well, yeah, and they
all have their limitations.
It also changes with the market, and I'm sure a lot 100%. Of lenders saw when COVID started what happened there, and it all froze. And then, of course, it came back.
I got so busy during COVID.
Oh yeah, it's like everybody needed a debt fund. Everybody needed a debt fund.
Once the balance sheet became imperative, right? Once it no longer became feasible to sell everything that you produce, because cost of capital is no longer 3%, it just became unfeasible for our clients to rely 100% on the secondary. And so the debt fund became a massive trend upwards, and I specialize in forming debt funds. So we got really busy in 2020, and it's got busier and busier and busier because the rate hikes just made it 10 times worse. So right now it's kind of conventional wisdom to say, all right, well, if I want to pursue a bank line and I don't have my own capital, then I need to go raise the capital. And so a fund-based structure, I think you guys refer to as an equity-based structure. So, when I say debt fund, I mean like an LPGP or LLC manager structure that offers equity to its investors, puts you in kind of the best position possible so you can get that bank line, right? And you can also have all that additional plug-in from different capital sources, and it puts you in the best position possible, I think. So.
Yeah, I mean, they're all tools. I think that this industry is based on the fact that you can control your own capital and underwriting, but that doesn't mean that that's the only way to do it. Like, here's an example. Like, we haven't sold any loans or done the institutional thing, but we've looked at it many times. Like, we want to know what's in the industry and what are they doing. And one thing that tool can be used for is the fact that they'll do deals that we won't. Like, if we know a loan, the right loan amount here in DC Metro, the right loan amount's $500K on a piece of property, they're doing 700 all day. And so that is a tool that you can use to get deals done that you wouldn't do with your own cash.
It's kind of weird how that works, though, right? Because like sometimes it's both, right? A lot of clients tell me they're becoming too stringent, but at the same time they're doing deals that they wouldn't do. So it's a very weird time with the institutions. It's getting better. They're getting a lot more stabilized. And now with securitizations coming out, more volumes picking up, I think it's going to be a better time. And it's a resource that everyone should be using. I don't think it's I don't think we should disregard it. I used to disregard it. I used to say, hey, but no, I think it's real, because a lot of them are one of the things I always tell, local lenders and retail lenders is a lot of them are investing in retail origination businesses, right? And they're building that vertical channel. They're adding a vertical integration to their business, so they actually have a retail origination channel. So you have to really think about
like a
them
raw
as
capital kind of setup.
Exactly. So you might want to think about, these guys will become your competitors if you don't work with them, right?
Yeah.
So you want to have that relationship with them. And, if you look at the national data in most markets, Kiavi, which is a big institutional outfit,
yeah,
they're number one, right? And they're a retail lender. So, it's this industry is becoming very institutional. But the nice part is, what I love about this industry is, because the fragmentation, they can only do so much, right? They own about 20% of the market share. That's about it. And 80% is everybody else, which I love. I love that.
Is that right?
fact.
I did not know that.
Yeah, I didn't know it either. We had our conference a few weeks ago in Newport Beach, and I sat down with the guys from Forcasa. Shout out to Forcasa. They're awesome. If you're not using Forcasa, get on there right away. It's the best data source in our space for volume. That system showed it in hard money. Like 20 to 25% is held by all the big, all the guys, all the household names you guys can think of, right? The RCNs of the world, right?
Sure.
Shout out to Jeff Tesh. Like, they're doing great, but they only really have about 20, 25% of the market, which is really cool, because that means that there's so much opportunity to be had in our space, and it's all dominated by the local guys, which I love.
Yeah. I mean,
I wouldn't have guessed that. I would have thought it was opposite. I would have thought it was 80-20 the other way.
You think so, right? Because on the day-to-day, you hear those names being thrown around all the time.
Yeah. I mean, there's just so many, self-directed IRA investors, so many companies that have, a few million of their own money deployed. Like, it's just, we've got 25, almost 3,000 private lenders that are not using institutional capital in our mastermind group, or our mastermind group. So, like, again, until that started growing, we didn't realize that either.
Right.
And I will say, those one-off private lenders, one of the questions that we probably get the most, or where there's the most chatter inside that group, because again, they're smaller lenders, like they don't know, there's no manual training guide, to do so. You ask 5 attorneys, they might tell you 5 different things, because you guys specialize in this space, but a lot of folks don't, and they don't get it at all. One of the common things they ask is licensing requirements. Like, do I need a licensing requirement? Yeah. What states need a licensing requirement? Do I need a broker, lender, servicing, and an NMSL? Like,
and that's the beauty of our industry, is that it's not well understood. It's allowed us to grow and build market share. First of all, I would encourage all your listeners, and also your mastermind folks. Our website has webinars assembled for probably the past 6-7 years now, and we've done this licensing discussion probably at least 5 times. Right now, I'll tell everyone, like, licensing in private lending, because private lending is so fragmented, there's so many different ways to do deals, but the most common deal structure is going to be your non-owner occupied business purpose loan, secured by residential real estate, to an entity borrower. If you meet those fact pattern, which is the most common fact pattern, if you meet those fact patterns, licensing requirements for lending is actually pretty nice. Only about 10 states require a license to do that kind of lending. And it's mostly on the West Coast. So let's go from the East Coast to the West Coast, right? So on the East Coast, it's just Vermont. North Carolina does require some kind of bonding requirement if you're getting started, but it's not a license per se, it's just a bond. Then you have Minnesota, and then you have the Dakotas. And then as you get to the West Coast, you got a lot of licensing. So it's going to go, you got Idaho, you got Utah, you got Oregon, you got California, Arizona, Nevada. Not that bad, right?
Right.
And a lot of these states, even if let's say, for example, you're a self-directed IRA private lender and you're originating deals and you're working and you want to do a deal, let's just say in Utah, right? It doesn't mean you can't do it. It just means you have to find a local lender to broker it to you. Right, that's what usually what most of our clients will do, is they'll get origination from local brokers. You can still do that, right? And so there's a lot of wholesale exemptions to these licenses. And so in California, it's the same way, right? So you can do a lot of that as a individual hard money lender, private lender, and not necessarily pursue the license because the licensee is bringing it to you for funding, right? And so that's the great part. Now, if you deviate from that fact pattern, right? For example, individual borrower, right? State of Virginia is going to hit you with a licensing requirement, right? State of Washington is going to hit you with a licensing requirement. You don't, everything's a little bit different, right? If you change that fact pattern,
DC.
Some states owner occupied
yeah.
need a license, right? Other states owner occupied don't need a license as long as it's business purpose, like other states so every state's a little bit different in how you approach it. But if you meet those, if you're lending in that fact pattern, then yeah, it's those states. And if your guys' groups are primarily kind of east of Texas, it's not a lot to worry about,
right? One question I heard on an episode of your podcast, you mentioned something very niche in Colorado about licensing.
Oh yeah,
do you remember what that was?
Colorado is a weird state. So when peer-to-peer lending came out back in 2008, they reacted and they said, all right, well, we're going to regulate this. And so they said that anyone who's doing what we call trusted investing, right, offering trusted investments, or I think they call it, co-lending on the East Coast, I've heard it called multi-beneficiary lending. The idea is if you're basically arranging a loan to be funded directly by high net worth investors, they have a statute on their books that says the company that's brokering that deal, the issuing that deal or arranging that deal is considered a mortgage broker dealer. So it's not even regulated by the mortgage regulations. It's actually regulated by their securities regulator. And
mortgage
broker that's why dealer. If you look at Colorado, nobody does these trusted investments, whole or fractional. They don't do them. Everyone's got a debt fund. Everyone's got a note offering. Everyone's got something else because you just can't do that particular thing. And I spoke with a regulator on this issue. I was like, I can't believe you guys haven't repealed this yet. And they said, we understand that it's antiquated. We understand that it's poorly written, but we're not going to repeal it. And we reserve the right to enforce on it. So I tell anyone that's doing trusted investing in Colorado, just don't do it. It's not worth going through the headache of getting that mortgage broker dealer license, especially when you don't need a license to lend in Colorado for this product, right? So I wouldn't do it. And there's so many different types of structures you can pursue in Colorado instead of trusted investing. So,
right.
It's not like it's the only thing. And sure, investors might say, oh, I have to be on title, right? I have to be on. Well, hold on.
Yeah, I mean,
I'm not going to risk my well-being to, satisfy your strange need for control, right? So
yeah, I mean, if you're in this business for long enough, those investors realize very quickly they do not want to be in public record.
See, that's the thing,
that's another
right?
Conversation.
When I first got to this space, I had never heard of whole or fractional. I had never heard of that before because I came from the banking world, and I got into this space, and I'm like, wait a minute, you're telling me that individuals are funding these loans and their name is on the loan documents? Are they crazy? Because
exactly.
in the banking world, like compliance and litigation and risk is the biggest concern. It's like, are you crazy? The borrower is going to sue you directly, and sometimes they literally put their individual name on the deed of trust. It's like, it's
trust
mind-boggling.
Me, we learned this one the hard way back in our early days, like pre-2010, where that was the structure starting out back then, and we put it wasn't even co-lender, is funding the whole thing. His name, care of Hard Money Bankers LLC, on the note, on the deed of trust, in a property in DC, a bridge loan, went into default. Instead of going to foreclosure, we got sued by the borrower, and our poor capital investor got dragged into DC Superior Court along with us.
Yeah.
And so we learned the hard way. The guy was scarred. We had a good exit. We were fine, won the case, had a fine payoff, but the guy was scarred for life. He never did a deal with us again. And
that's why
when we changed the structure.
Whenever I go to these, like, kind of like IRA events, or I meet investors and they kind of obsess about the trustee side of it, I'm like, that's just no good reason to do that. Like, there's so many other ways to do this. So
right.
I never understood the logic except for the need for control. And I think that trumps a lot of the logic with investors, because the need for control trumps everything else. Right. And I think that's just really risky. It's unnecessary.
Well, I mean, a lot of lenders don't know. I mean, a lot of folks in our audience are, ex-real estate investors, ex-corporate America. They have a few $1,000,000 and they're like, I want to be the private lender on these deals. And they just start doing it. And next thing you know, they wake up a year, 2, 3 years later, they're like, this is a business. I'm making real money on this. Am I even doing this compliant? another big thing is, commercial usury laws, which change. And, we get asked those questions all the time. And I'm like, I don't know the answers in these different states until I have, a contested foreclosure or something, and they carve it down. And from what we've heard, some states, maybe it's Florida, you probably know better than us, that, if you charge over 18%, it's technically criminal instead of civil.
Yeah. So a lot of states have their usury provisions in their penal code, but I think that that's really designed so that the DAs can go after organized crime. I've never heard of a real lender getting in trouble criminally for usury. Good. Now, the reality of usury, though, it's the one way they can really invalidate the loan, right? Yeah, you did a loan without a license. Most states aren't going to invalidate your loan, right? It's a arm's length transaction, bona fide lender. Yeah, you didn't have a license. They don't want to, that's overreach, right? But in usury, right? Usury is a big enough claim where they tend to really get aggressive with it. So you don't want to mess around with usury. Thankfully, like you said, commercial, right? Most of the country, especially in the Midwest and the East Coast and in the South, most of the country, it's, commercial transaction, no cap, right? No, when I say no cap, no usury cap, right? But there's a reasonableness standard. There's always a reasonableness standard, right? Sure. So the idea of, is the rate unconscionable, right? So don't go out there be charging 32%, right? Because if it shocks the conscience of the judge or the jury, you have a problem on your hands, right? So don't be doing that. And then you have some states like Tennessee where they have this very strange usury exemption, a usury standard. It's like prime plus 2 or something like that. And
that's right.
Sense. So, but the nice part about Tennessee is they allow, and this is why it's important to, have an experienced attorney. They have this exemption where, well, if you utilize out of state law, if you borrow out of state law, that's permitted, provided that you don't have a nexus with the state of Tennessee, right? And this is very common. Most lenders who lend in Tennessee are not local to Tennessee. And if you look at Tennessee, the hard money lenders in Tennessee who are local to Tennessee all have this license. They have a mortgage license or
it's like a banking license or something, right?
Yeah, thrift and industrial loan license. Yeah, it's basically their equivalent of C&I financing license.
Is that just so they can charge more than, we'll call it 12%?
They can't borrow out of state law because they're local. They have an office. They live there, whatever. And so they're not going to be able to just freely use, for example, Texas law or Florida law or something like that. So what they're going to do is they're going to get the license so they can exceed the usury limitation. So there's a lot of states like that where the license is exempt from usury. And the biggest state where this is known for is California, right? California has the lowest usury cap that I'm aware of. It's 10%, right? But if you're licensed, there's 2 licensing regimes. If you're licensed, you are exempt from usury. And so that's why in California, they get you 2 ways, right? They get you both from the licensing standpoint and the usury standpoint. Probably one of the worst states to lend in right now, but, there's a lot of opportunity. Is California real estate still relatively
the loan amounts are huge. The loan amounts are huge. They're hard to stay away from.
Exactly. And the rates are up, right? California average rates are in the 10s right now. So, it's not unattractive and it's still a non-judicial state. So we get a lot of questions from new lenders about California. And I usually have bad news. Like, sorry, here's the way you can transact here. And if they're out of staters, it's even tougher because they don't have access to the networks here. So,
yeah, I mean, you either have to go if you want to lend in California, you have to go all in and, invest in the licensing in the legal representation and having all of your boxes checked.
And sometimes it's worth it, right? And
sure,
if you're growing and if you're if you're a Texas lender, a lot of Texas lenders have invested in California. It's a logical extension for their business. So,
cool. You have questions?
Go ahead, Chris.
No, I was going to switch gears, so you go ahead.
No, mine's switching gears too. So go ahead.
All right. I wanted to ask a couple questions about the podcast. How'd that come about initially? What was the motivation to be I'm going to make a podcast
there was no
about
motivation.
this industry?
COVID was the motivation.
That's when all podcasts started.
Yeah. So what happened was we had our Innovate conference. I think it was February or March. It was the year before COVID. And we had heard the grapevine that Steve Pollock, the founder of Anchor Loans, is going to retire. And I really look up to Steve. I think he's one of the very few guys who like bootstrapped a national business and sold it to an institution. Very few people have done that, right? Not
Yes.
institutionally backed by any means,
Very
right?
rare.
When he started. So, and he's also just an interesting guy, right? He, he's an optometrist. He went to Berkeley. I went to Berkeley. He played professional poker. All these cool stories, and I knew this about him. I was like, because of local trade associations, and I was like, well, Steve, let's get an interview on the books. We're at our conference. We got the cameraman here anyway. Let's just do an interview. So we had the interview done, and we were like, well, it looks great. Let's use it. And I had just started getting into podcasting, listening to podcasts, and I was kind of late to the game. And then COVID happened, and so we were pretty bored. So, as our marketing team was like, well, everyone's at home. We kind of need a lot of content because we're not going to conferences. So let's start the podcast. So literally in my bedroom during COVID, I started calling my debt fund clients because they're obvious choices. And we started interviewing them over Zoom. It was really ghetto back then. Didn't have this nice fancy mic. Had a stupid gaming headset on, and it was awful, right? And the cameras weren't that good back then. So, and we're doing it in my bedroom, with a really crappy virtual background. And then it evolved, right? So the first season was mostly like that. It was kind of awkward. Second season got better because I went to a conference after COVID ended, and everyone was like, "We're listening to your show." I'm like, "You listen to the show?" so people were asking me who I didn't expect, like people at the institutional shops, the aggregators were asking to be on the show. I was like, okay, cool, let's do it. And also, other friends of like vendor friends were asking to like buy ads on the show. I was like, what?
Mm-hmm.
So I didn't know that it was that. I still don't believe that it's that popular. I'm shocked when anyone tells me they listen to the show, because to me it's a very dry topic. We don't get controversial,
You're just sharing your message, just like we're doing. We're just sharing our message. Like the joke we have internally is like no one else besides industry people understand this anyway. It's not like you can go talk to your like
right
friends and family about some of this industry.
And now it's we've got this whole machine going, and got all the branding behind it, and it's been really, really cool because able to have long format conversations with these sponsors that have built massive businesses and even local businesses. Like, we don't care. And so now we're in the challenge of like, okay, how do we keep this thing fresh? Right. So, we're gearing up for season 5. We're not sure how we're going to do it. We're thinking of ideas. We have a list of people that we want to interview. So we're not sure. Right. But it's really cool because you can actually really get, it's kind of corny, but behind that curtain, right? And try to figure out like how this guy ticks and what made him choose certain things.
Yeah, I mean, it's an awesome cheat code, like just listening to podcasts. And we get similar feedback from listeners of this show or people who watch on YouTube. And you're right, it can be a dry topic, but if you're into it and you're making money from it and you're looking to grow in it, it's not that boring anymore, right?
Right.
And so some people will contact us and be like, "Oh man, I'm working my way through all of them. I'm on episode 55," and I'm like, "God, you listen to all of our podcasts?"
it's to me, it's like, it's like I've never been one to like I get uncomfortable when people like compliment me, so I'm like, thank you for listening. I'm surprised that anyone actually listens because the data doesn't really show it. But what's interesting is that now you're getting this like evolution of like we typically tend to interview. We want to get in front of these like big events, right? So like when Bill Tesser stood up CB3, like we wanted to get ahead of it and get an interview in the books, and he agreed.
That was a great show. That was a very good interview.
That's the cool part is we're getting like we're able to get pretty quickly, at least, to get a conversation going with a meaningful event and get his side of the story. Because there was this big drama whirlwind going on in social media. And so, the whole civic situation. And I wanted to get his kind of side of the story and version. And I was surprised. Usually you would have this kind of guarded, he was very frank with me. And it's surprising how honest people are on these podcasts. Because it's, there's a lot of people watching them. But still, they're being very honest. And you learn a ton you kind of read between the lines. And I learned a ton about how Bill approaches his business, and it's you
So
got to
did
give him
I.
credit. Credit's due. I mean, he kept that much brand loyalty from his staff. That's unheard of. So.
Yeah, no, he's dedicated to his team. And one of the main takeaways from that, hearing the whole backstory and with Civic and everything else, that was very cool. But it was nice to hear from an operator in our industry who's such a killer. Like
Right.
that guy that's top notch in any industry. And
Right.
he's in this one. And I'm like, that's cool.
Yeah.
Like,
because I wanted to do that. I didn't want to do the whole like come on my show and pitch your business. I wanted to do to get more the business side of things, the entrepreneurial side of things,
Right.
but also the backstory. Because a lot of times people forget about these backstories, and it's really influential, right? You see a difference. Like you see the guys that came from the real estate world, you see the guys who came from the Wall Street world, you see the guys who came from special assets or banking, and then their businesses reflect it. You can kind of see the differences. So
yes.
that's where I
That's exactly why I started listening to the show, is because there is so much going on at those companies that we don't see here at HMB.
Right.
Like we've had the same, capital investors around for over a decade. We lend to a lot of the same people, we've been in the same geographic market. We talk to each other. And I mean, we do have an awesome outlet through the mastermind to connect with other lenders, but that's mostly it's mostly like us training them, us helping them. And that's awesome. And it's been fantastic to see. But I checked in on your podcast because that's a side of the industry that I don't get in my day to day. I wouldn't know anything about otherwise.
Right.
And so having that additional industry knowledge, it also made me want to start going back to conferences. We haven't been on the conference scene in so long.
It's a double-edged sword for lenders. It's tough. I get it, because you got to concentrate on getting deals done. It's tough.
Where do you see that side of the business going related to growth? I mean, I know there's definitely some big names that have gone out of business since October 2022 when short-term rates went up a lot, and there's that side of it. One thing that's never really mentioned publicly is like what people are doing to prevent buybacks, and are buybacks very relevant now? The market's changed. Rates are higher, market's slower. You always hear the good. Everything's based on production. But there's
a lot of drama there, right? So the buybacks are you're hearing about buybacks. They're happening, right? Mostly about like early default buyback or fraud buyback risk. It's a real thing. If borrower fraud's up, right? We all know it. And so there's that. There's the stress points of selling are still there. And that's not. I don't really blame the buyers. Really, it's just the market pricing is just fluctuating like crazy, right? Every week we have a new. Rates are different, right? So, and they're all scrambling to do, and they're all customer focused. They want to make the customers happy. It's challenging to be in such a, I guess you can call it volatile market, to use a overly used word. It's very tough right now on that side of things. But that's also, where there's volatility and where there's chaos, like it's where the local guys have been able to really clean house, right?
That's what we've been doing all year.
It's helped us a lot.
Okay, we'll use this when we can, but we're not going to rely on it. It's easy, but we're not going to rely on it because it's proven to be more difficult than we thought it would be, or how it once was. Back in compared to like 16, when in 21, and even in 21. So most of our local clients and our retail clients are really just taking advantage because they're relying on speed of execution, and their pricing is actually better sometimes than the institutional guys is, and so they can get things done in a more efficient way. That's the back and forth, right? On the shuttering, I don't expect to see anyone shuttering, kind of household name shuttering, like we saw back in 22. We saw a couple companies shutter. You're probably going to see more of it on non-QM than in our sector. We had a few shutdowns in non-QM. I think in our sector, I think we're going to see actually some interesting evolutions of, like, they're going to be big announcements by regional shops that no one's ever heard of on the East Coast. And, but on the West Coast, they're household names. And they're going to announce, like, there's going to be like securitizations being done, like big things happening, and acquisitions happening. I think it's going to happen because it's been kind of, a lot of folks are growing and they need to swallow up market share and they need more volume, and they're able to do it. So there's going to be some big news that way. I don't know about, shutdowns of companies right now.
I mean, it it would take a real dip in the real estate market for that to happen. And that
that or a real new kind of chaotic event on capital markets. Because what I get nervous about is there might be, and I'm not sure about this, but there might be companies that are just haven't set up their capital in the right way, and one little blip in pricing can really cause some chaos. And so it's happened before, right? It happened 2 years ago. A couple buyers, had to shutter. So that could happen, but the buyers have been much more conservative, much more measured in their approach. So, and also like they're not buying everything they can. They're being much more measured. So
yeah,
I think I think they're understanding where they can take risk and where they can't. So.
Well, yeah, but also what goes with that is just less volume. And if there's less volume, there's less players in the space. Right. So that there's the risk, and then there's the risk, and there's also the deployment amount. If like none of these big buyers are going to get in this space if they can't deploy enough capital for the right returns. And as the markets change, slow down, and again, I'm not saying they will, but if they do, I'm curious to see what ends up happening there when they created this $1 billion facility and they're trying to buy up $1 billion, and it's like, oh shoot, we only were able to buy up 600 million. Let's take our football and our capital elsewhere to a different industry.
That's one of the kind of common myths in the space about like these larger revolvers at the institutional level. It's not like they're just pre-authorizing the revolver and they're going to do it. It's really more of a liquidity play, right? So I've got $500 million of loans in my books. I'm going to move that to a securitization revolver, and now I've liquidated my portfolio. I can go out and do more, right? And so that's really the move. And so. And they can kind of draw on that revolver as things pay down and use it, right? But and also like no bank is going to be pursuing a $1 billion plus type revolver. It's going to be a couple $100 million at a time, and that's going to be kind of choppy for a little while. But once they figure out the secret sauce for that, and they kind of standardize that, I still think that it's going to be a pretty large sum of capital flowing into the market. The question is really what you said, Jason. Is there going to be enough volume to support it? It depends on who you ask. I don't see it. I honestly don't see it, right? And I'm on both sides of the fence, right? I'm working with the institutional guys. I'm also working with local guys. I just don't see it. But you talk to lending companies that don't live in our space, just dabble in our space, and their perspective is that our industry is ignorant to the fact that a lot of this volume actually comes from non-QM and from conventional. Those guys have access to so much more product, but because we're not licensed and living in that world, we're ignorant to it. We've got blinders on, and it's supported by the argument by the fact that, like, for example, Jeff Tesh goes to consumer conferences. Why, right? And it's because the fact that there's deals that they want coming from those originators. So it's an overlooked arena, and I think that's where it's probably going to come from, right? And they're going to be looking. Those originators are going to be hunting for more of that product because they're just really quiet on everything else, right? So
I mean, there's also as those rates went up, and that institutional backed capital was. It's still cheaper than our capital. I mean, we lend out at 13 and 3, 12, 9, 9 and 3. Before we were significantly higher, but not anymore. I mean, it's not all that much higher. And
no, they're not that far off.
Yeah, and again, I'm not saying short term. The rates, that they're basing this off of are going to continue to increase. But if they did, then all of a sudden it's like, oh man, like we already talked about the 75% of this.
You're not going to be the price of bond. That as low as long as Fed rates where it's at, like in somewhere, and 10-year treasuries where it's at, and within deviation of where it is, you have to price these bonds higher. So there's no way that like back when back in 2021 when these buyers are just gobbling up everything at like next to nothing pricing. You gotta remember interest was next to nothing back then, like 3%, right? So it's not the same story anymore. And so I don't think that we're going to see bottom of barrel pricing like we once did, but they are a little bit cheaper where it's like, oh, they're either going to be a little bit cheaper or they're going to be push leverage a little bit more. And that's the reality of the ability that they can take that risk. So So you got this imbalance caused by it. But the nice part is retail lenders have told me, like, for as long as this has been a thing, we've never had a problem on volume. Right. So it's the clients that have been like, that doubled down their business into that arena.
Yeah.
Right. And conformed everything they do into that arena where they suffer, because now they can't capture the really true hard money type borrowers, which is actually the vast majority of the borrowers. So there's that imbalance that people are losing. And I hate this argument that, there's a difference between private lending and hard money. There isn't.
No, they're interchangeable. And I kind of like the fact that the industry like evolved into the, private money, private lender terminology and away from hard money. Because I always thought it was kind of a silly name. Only problem is our company's named Hard Money Bankers. Anyway, that's a separate issue.
Fine, though.
I know
some of the largest volume originators in the country, lenders in the country, number one lender in Dallas, number one lender in Denver, number one lender in Arizona. He uses hard money on his website. He's doing the same thing.
Oh, sure. Yeah.
Yeah. So I don't
still
care.
call that on some level. No, nobody cares.
It's also like, what do your borrowers call it? Right. That's the most important thing.
Right.
If they call it hard money, if they call what you do hard money, then you are doing hard money. That's what I say.
Sure. No, I just want to wrap up real quick on the capital markets conversation. There was some interesting stuff I wasn't aware of. And I think a good takeaway for the audience is that use the secondary market as a tool. It's good as a tool that you can have in your tool belt, right? But I would not base your entire business plan on that. It's volatile. It changes underwriting. It changes in price, and it might not even be here in the future. So like have capital that you control, and you can use warehouse lines. You can use secondary market sales. Like, keep that in your
all good resources, all the tools that are available, and use it, right? Use it to your advantage, but don't change your core thesis, because your core thesis is what's going to make it different.
Yeah, and I just don't like the idea of basing your business, your income, your everything on stuff you don't control. And if there's anything that's out of your control, it is institutional money. That is smart money. They call the shots.
Right.
Yeah, this has been awesome, Kevin. We certainly appreciate you taking the time with us. Any other follow-up questions, Chris? I mean, I think, I was really trying to ask questions that I think would be very valuable to the audience and to our viewers of what we see coming up in the Hard Money Mastermind. And, and again, even though Chris and I might think we know the answers to a lot of their questions, they are, we usually tell them to definitely, check with an attorney, CPAs, things like that. Because it's like, I know how we do it internally, and we've done 35, almost 4,000 loans since 2007. So like we've had contested foreclosures, we've been dragged into court lawsuits and things like that. But, you need to find the right competent attorney, and I'll tell you, for everybody listening, like, Kevin's firm is that right attorney. I mean, I remember meeting Anthony right when we got into the business, early on in some industry conferences, and and nobody was doing that. And most of the attorneys, like, people ask for referrals for attorneys, and I'm like, for local foreclosure and stuff like that, I'm like, it's just a localized person. Just because they can help me here is not gonna be able to help you there. Like, they're not going to know, well, who can write my co-lender agreements or my servicing agreements or things like that. And you guys are very unique because you can access every state, and you have the ability to do so. And even when we do loans out of state, I can't do it quickly because our local attorney doesn't we got to get local counsel to help with a deed of trust or a mortgage to get it on record.
We went through all that in our production. We have local counsel, we have them bless everything, and we've gone through the exercise of all the weird evaluations and also like the most obscure states like West Virginia, Alaska, Mississippi. We've done deals there, and all the intricacies of doing deals there. So,
and they all really do vary. So
every state's so different. They're all so different.
So different. Where can people find you if they want to reach out about legal work or whatever might be?
Our website's probably the best place, geracilawfirm.com. Pretty easy, GERACI lawfirm.com. We're also all over social media, LinkedIn, Instagram, Facebook. Also, we're on YouTube, right? So Geraci Law Firm, and the podcast is separate, right? So, we're all over. So I think you should be relatively easy to find. You can also just search me on Google and put hard money in there, and I'll probably pop up. So we spend a lot of time and energy on Google ads. So, Pretty easy to find.
Put that to work.
Oh yeah. And also another thing I would encourage everyone to start doing is really getting involved in the space. Like, it doesn't matter that you're small. And I always want to encourage everybody to take advantage of what the resources are in the space. Like AAPL, like even if you don't come to our conferences, we got one in August, but even if you just want to go to one show a year, just go to the AAPL show, because the education the day before the conference, you go there, you can go there and just navigate and network and meet people and learn from people. That's really the thing that I would encourage all the small guys to get started in, because everyone started somewhere, right? Lima One, Anchor Loans, they all started out small, doing trust deeds, right? So, and the best, why deny yourself that resource? So please get involved there.
I plan to myself. Like I said, I want to get more involved in the conference scene again. At least hit one this year.
Yeah,
I have a goal to do that. So
it's kind of a pain, because you're going to be in Vegas in November, but it's the one show a year that I just tell everyone, like, if you have to pick one, that's the one you want to go to.
Good stuff.
Yeah.
No, Kevin, thanks again. Very, very cool talk.
Thanks, guys. Yeah,
absolutely. Appreciate you taking the time. All right, guys, we will see you next time here on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.